Today's part with the following interruption for a public service announcement.
Welcome to the Investing Intelligence Show, where we talk about panics, market crashes, recessions, and occasionally AI stocks using analysis from the most advanced AI models in the world. I want to remind you that the opinions expressed on this show are just that, opinions. They should not be taken as specific advice to invest in a particular way. So it is March 28th, Friday, March 28th, and the NASDAQ year to date is down 10.15%. The S&P is down 4.9% year to date. And our portfolio is down 2.18% year to date. That means we're beating the NASDAQ by 8% and beating the S&P by 2.7%. But of course, we're still losing very badly to anyone who sold everything on January 1st or went completely to treasuries on January 1st. Regardless of that, how are we doing better than the NASDAQ and S&P? Well, so far, our best calls of the year were, first of all, to buy bond ETFs at the beginning of the year, buy treasury ETFs at the beginning of the year, but we should have done more of that. And we also called the bottom in Intel right when it was happening. And we promoted Chinese AI stocks right before they skyrocketed. And we called the bottom of this most recent sell-off about a month ago, 3 weeks ago, whatever. We went up since then, and now we're right back where we started. Be that as it may, we had a CoreWeave IPO today. Looked to me like the stock initially dropped, and then we made a small buy at $38.30. Our friends at Shipstock Investor were also doing a small buy to add to their small cap basket, they call it. So it looked to me like once retail realized it was actually available for purchase, that it shot up. And overall, not a massive win. Closed 1 penny up from its IPO price of 40. CNBC was saying it opened at 39. I believe it actually opened at 40. Not sure, depends on who you ask. And let's make a quick comparison here. So Nebius and Applied Digital are two companies you can try to compare it to. I'm not sure they're good one-to-one comparisons, but we'll work with what we've got. Nebius is a $5.2 billion market cap company, 26,000 employees. Applied Digital is a $1.25 billion company with 150 employees. So CoreWeave looks like they've got a market cap of about 18 billion. They've got 1,000 employees. But what really matters is their market cap in relation to their revenue. So annualizing from the most recent quarters, Nebius has a price to sales of 34. Applied Digital has a price to sales, also known as price to revenue, of 10, and CoreWeave has a price to sales of 6. That's 34, 10, and 6, meaning CoreWeave is the cheapest in light of revenue amongst those three. Yes, I know, CoreWeave needs money, and it has huge debt, and it has all sorts of other problems that the CNBC anchors were telling us about for days. But is it still worth a small investment on a pullback? Not necessarily this 1 penny up thing, but on a pullback as part of a larger basket of riskier stocks? Maybe not. So let's look at Astera Labs and ARM. They're the most recent IPOs that we've had in the AI sector. And Astera Labs IPO'd at $36, and now it's at $60. ARM IPO'd at 51, and now it's at 107. Both have had lots of ups and downs, but they both benefited from the fact that they came in at a good time for the AI bull run. CoreWeave is not coming at a good time for the AI bull run. Actually, I cannot imagine a worse day for CoreWeave to IPO on. So look, macro might give you a discount on CoreWeave. We're at $40 now, and if things keep going the way that they're going, could be at 30 soon, could be at 25 soon, could be at 20 soon. Won't be at 0 soon, but it's possible it could go lower. I'm also hoping we get a Cerebras IPO this year, but once again, things are not going well. So Cerebras chips are being used by both Mistral, which is a French AI company, and Perplexity. Mistral may not be known to you, but it's very well known in Europe. And Perplexity is the Google replacement, AI version of Google, basically. And they're both using it with lightning fast results. I'm not saying Cerebras chips are going to replace Nvidia chips. That's not going to happen. But it is an interesting prospect for IPO this year. So Nvidia had its GTC conference, which didn't seem to alleviate the extreme persistent skepticism against Nvidia for more than a matter of days or a week. And also, media capitalized on Jensen Huang's remark of him being the chief revenue destroyer. That's pretty much the main headline we heard on the Fin media. But let's actually go ahead and hear the full remark, which may shed a little bit more light on what he was actually trying to say.
Blackwell is 40 times the performance of Hopper. You know, I've said before, somebody actually asked, why would I say that? But I said before that when Blackwell starts shipping in volume, you couldn't give Hoppers away. And this is what I mean. And this makes sense. If you're still looking to buy a Hopper, don't be afraid. It's okay. I'm the chief revenue destroyer. My sales guys are going, oh no, don't say that. There are circumstances where Hopper is fine. That's the best thing I could say about Hopper. There are circumstances where you're fine. When the technology is moving this fast, and because the workload is so intense, and you're building these things, they're factories. We really like you to invest in the right versions. Okay, so we're not trying to sell you less. Okay, our sales guys are going, Jensen, you're selling them less. This is better. Okay, and so anyways, the more you buy, the more you save.
So another narrative that I've heard used very strongly against Nvidia is that they have this yearly cadence now. So they've switched to this every year we're bringing out a big new chip, and that's going to lead to lower margins because obviously we know ramping into Blackwell has led margins to go from mid 70s to low 70s. So if they're going to do this every year with a new chip, they'll never get out of the low 70s. Well, it just so happens this GTC really cleared up that misconception for us. So Blackwell Ultra, which is coming at the end of this year, is not a major upgrade. It's a small upgrade. The next major upgrade comes at the end of next year, at the end of 2026. So we're going to get Vera Rubin end of 2026. And then at the end of 2027, there will not be another major upgrade. It will be Vera Rubin Ultra. Okay, so what we're looking at here is not really annual cycles on their chips. It's every 2 years that they're bringing out a new big chip. Another thing that was very interesting is that Jensen did an excellent job of proving that Nvidia still has the lowest cost of ownership of all these chips, including custom ASICs. Now, he mentioned an enormous amount of companies, as he likes to do. Not that it matters, because we know we're long past the era when companies shoot up on getting a mention by Jensen Huang. But I will note, among the companies that he mentioned, he put a lot of emphasis on Dell and Cadence. Among the companies that he didn't mention, I didn't hear SMCI mentioned once. Maybe I missed it, but I really, really don't believe I did. I also like their mention of the DGX Spark and the DGX Station. So looking at the massive adoption of AI by different types of users, they're trying to develop not your standard data center chip, but chips that can be used outside of data centers by individuals and teams. The Spark is more of an individual type of GPU, whereas the DGX Station is focused on enterprise users, so data scientists, researchers, things like that. So a new market for NVIDIA. Before we talk macro, I really can't avoid pointing out the fact that since our last recording, it has become glaringly obvious that China is starting to win the war on AI, especially in certain areas. Now, I've got a new AI startup that I'm working on, and we're using a lot of AI video. And we found that not just the number one best AI video generator, but like the top 3 are all from China. So how is it that they're winning in AI video? Well, it's pretty simple. They've essentially stolen every single frame of video that the United States of America and probably even other countries have ever produced and put it into their data set. US companies like Google, for example, OpenAI, Anthropic, they're a little more hesitant to violate copyright to that degree. Now, actually, in this past week, Google and OpenAI told the Trump administration that if they're not allowed fair use for AI data scraping, China will ultimately defeat the US altogether in every type of AI. So it's really critical that they get that fair use exemption. Otherwise, we're pretty much handing the ball to China, according to Google and OpenAI in their recent memos to the Trump administration. So China is not only beating the US on the data side, they're also engaging highly effectively in psychological warfare against the US and the US's AI-led financial markets. Okay, so Chinese tech executives just recently came out. You might have heard the big headline, oh, the data center build out, it might be overdone, according to an Alibaba tech executive. Well, China doesn't actually even have enough data centers to run their own highly popular models. Okay, that's why DeepSeek has fallen way down on the leaderboard list of apps, because they literally couldn't even run their own models because they didn't have enough GPUs. So this idea that the build out is overdone is patently false, according to the actual facts of the situation, even in China. Now, there was also this story about China limiting H20 chip imports because of power concerns, when in reality, China needs every single chip they can get. So that is just psychological warfare and nothing else. But both of these stories push down AI stocks once again. DeepSeek was a massive false narrative win, and the false narratives from China continue. I'm not saying that their models are bad. Their video models are actually the best, unfortunately. But they do need every single GPU they can get. So we had a recent story out of Bloomberg that really traced the smuggling of GPUs into China. If they're doing their best to smuggle NVIDIA GPUs into China, I highly doubt that there's an overbuild of data centers on their side or anyone's side. So why does China feel the need to win on AI? Obviously, your first thought might be military defense, things like that. But also, a lot of financial analysts believe that they're in a depression right now. So not a recession, but a depression. Every single dollar that they can get American investors to pull out of Nvidia and put into Alibaba and Baidu and BYD apparently now passing Tesla in electric vehicle sales, every single dollar is a good dollar for them. So that being said, I think it is important to understand that the narrative in America strongly against AI stocks by some analysts is a little bit overdone. We're not talking economy yet. We'll get to economy in a moment. But let's hear from Stacy Raskin, who is the top US tech analyst.
Yeah, so I think I heard in your prior segment, if you liked it before, you should love it now. I've been a little, I guess maybe surprised is the wrong word, but I mean, I've been a little surprised at the magnitude of the decline. And I get it, the whole AI space has kind of rolled over somewhat on DeepSeek and macro and tariffs and just a broader degrossing, and I get all that. At the same time, Nvidia, I mean, we're right at the beginning of their Blackwell product cycle. It has just started. It is likely to be the biggest product cycle in their history. I think it still looks really, really good. And at these current valuations, I mean, it went down to 23 times earnings. It's about 25 now. It's at trough valuations. You've been really, really good buying it there, like historically. I think over the last 10 years, if you bought it at 25 times or below, your average one-year return from that moment was like 150%, and it's never had a negative drawdown over a one-year period. Buying it under those, I really like it at these valuations.
But the DeepSeek thing changed the way that I think I should think about the future, perhaps for this company.
But it's already had an impact. But what impact has it had? It's been a positive impact, not a negative impact. This was my read on Deep. We talked about this, I think, during that circus.
I know we did, but has it already had that? Just because Satya Nadella and others like you come out and say, well, it's going to lead to more compute, which leads to more chips and blah, blah, blah. I mean.
But what's happened since then? So we've seen H20 like inventory, like in public cloud inventory has gone down. H20 rental prices, I'm sorry, H100, excuse me, inventory has gone down. H100 rental prices have come up. H20, their China sales, like their sales of their China legal parts into China, there's a ton more demand like on the back of DeepSeek. They need more compute, not less compute. All of the hyperscalers and everybody else has been taking their CapEx numbers up by leaps and bounds this year. Again, I think from your prior segment, what I think came out of some of the conferences in this latest season is that those spending plans are still very, very intact. If anything, we've seen increases in demand, not decreases from and since DeepSeek, and that's been my view. But I thought it was positive. Again, the market clearly disagreed, but I think it was good. I think the prevalence of more cost-effective models drives adoption. That's been one of the big barriers to adoption by software companies and the like. It's cost. If we can actually get effective, lower-cost models that drive adoption everywhere, how is that not a good thing?
So within the first 16 trading days of this year, the S&P was already in correction territory. That creates what we call a wealth shock. Asset price inflation carried the economy up until this year. And unfortunately, the stock market decline since then has created the 13th largest wealth shock in U.S. history. So U.S. consumers are expected to pay $2,000 more for general purchasing just due to tariffs on China, Mexico, Canada, steel, aluminum over the course of this year, in addition to losing their money in the stock market and experiencing that well shock. Car buyers, God forbid, you need to buy a car this year, you're expected to pay an average of $4,000 more for a new car. Economists are overwhelmingly in agreement in a way that I've never seen before. And what they agree on is GDP growth down, inflation up, jobs down, unemployment up. It's very, very important that you as an investor understand the economic effects of political actions. All right, so let's break it down. The current administration has a five-sided effort to reshape the US and global economy, and it includes tariffs, DOGE, tax cuts, deregulation, and immigration. Tariffs. What is the goal of their tariffs? Well, it's to bring manufacturing back to America, force other nations to reduce their tariffs, and raise money for the US. Here's the problem.
Well, I mean, this makes no sense to me economically and no sense politically. So what are we saying? We're going to bring 100,000 manufacturing jobs back to the United States and tank the stock market by $20 trillion in the meantime? Do you think the people in Florida living off, the accumulated wealth that they've done in the last 10 years are going to be all excited about, some plant that Trump saves in Erie, Pennsylvania for 300 jobs or 500 jobs? By the way, producing something that they could have brought cheaper without the tariffs beforehand. I mean, it just doesn't make sense. I hear it, but then I think of the politics of it, and I think of the economics of it, and it just doesn't wash. Yeah, we do. There are unfair trade practices. We want to normalize some of these, but this grand vision, the cost parity is just nowhere near there. And the political parity does not speak anywhere in favor of the Republicans or for the American public. Don't forget, almost half the American public owns stock, if not directly, indirectly, through their 401ks, through their IRAs, through their pension funds. You have 180 million, 150 million people there. So, we're going to bring some manufacturing back to the U.S. How many jobs is that? Less than 0.1%. So they're going to get a little higher pay than they would otherwise. Where's the politics there, Scott? I don't see it. Maybe someone can tell me.
Okay, well, what about force other nations to reduce their tariffs? So far, we haven't really seen that effect. Rather, we've seen that other nations are ratcheting up. Sounds like the EU is preparing right now to ratchet up tariffs. Okay, well, that still leaves raise money for the US. So actually, decreased growth is expected to occur due to these tariffs. A decrease between 0.5 and 0.7% on GDP is expected to decrease tax revenue, notwithstanding the fact that the IRS was already predicting a 10% decrease in tax revenue before the tariffs even went on. So the conclusion of the U.S. investing community on tariffs, the first of the five aspects of the administration's plan, the conclusion is harm done with no objective achieved. That brings us to DOGE. So the goal of DOGE is to cut $1 trillion off of federal spending to reduce the U.S. deficit. But are we really going to sufficiently cut federal spending, and is it really going to go straight into the Treasury to reduce the deficit? Let's see what a real expert has to say about that.
I do have DOGE doubts. Now, this is an active discussion within the walls of PIMCO, so this is my personal view. Sure. But if you actually look at, and this is, again, mind-numbing process, but actually quite important, anything that is the Congress has already appropriated, spending that they've already appropriated, that gets then kind of cut or pared back by DOGE, that does not go to the Treasury General account. That does not go to pay off the deficit. That by law goes with basically a checking account within that agency and has to sit there for 5 years. This, I don't think necessarily the market understands. That means that, again, these make good sort of sexy headlines, if you will. But in terms of actual deficit reduction, we definitely haven't seen that yet, and you have to get that enacted by Congress and codified into law.
So real economists know that we would have to increase taxes or reduce Social Security, Medicare, and Medicaid to make the change that we need in the deficit, period. So the conclusion of the U.S. investing community on DOGE, harm done with no objective achieved. That takes us to tax cuts. What is the goal? Well, let's actually hear straight from the administration itself on what the goal is. Here is Treasury Secretary Bessent.
Does tax cuts get made up with tariffs, or does tax cuts get made up with cutting government spending?
Well, tax cuts and deregulation will change the growth trajectory.
Grow GDP.
Will grow GDP. If trend line has been 1.8, if you can move the growth to 3 or above,
right,
then you really change the trajectory. And if you can keep expenses flat or do the unthinkable and cut expenses, then you can really...
So this is important. So government revenue as a percent of GDP can go lower if you have lower expenses and a faster growing economy.
Yes.
I think that's like really important for folks to understand that relationship. And so in isolation, tax cuts might reduce revenue. But when done with reduced government spending and deregulation and a reordered international trade model, you theoretically will accelerate economic growth in this country, increase government revenue overall, even with a lower tax rate. That's kind of the theory.
So the goal is to reduce taxes to boost growth. And with that added growth, we'll also generate more revenue to reduce the US deficit. Is it really going to work that way, though? Well, let's hear from an expert who actually knows.
The bill that they're trying to pass, by Memorial Day, whenever it passes, I don't care, they're extending the status quo. So there are no tax cuts even built into the $4.6 trillion tax bill that they need to pass this year. So there are tariffs and there are not tax cuts. And when you sell tariffs as tax cuts, you create a pretty material disconnect between the consumer, who is confused now about what they should be expecting, which is why you see pullback at the big box retailers and people delaying big purchases, which is what's leading to that soft data that's so problematic right now.
Henrietta, what happened to the carrot and stick approach when it came to tariffs and corporate tax rates? I thought if you produced in the United States, potentially you could get a 15% corporate tax rate. Where did that conversation go on Capitol Hill?
That conversation is nowhere right now on Capitol Hill. Each percentage point reduction in the corporate tax rate costs $150 billion. So as I mentioned, we're already at $4.6 trillion just for the status quo. We got to fix the SALT cap, even just to raise it up to $20K for couples filing jointly. We have to extend the child tax credit. The president wants to do things like eliminate taxes on tips, which is itself $175 billion. We do not have the money for a 15% corporate tax rate. And even if you did, I'd like to relay that the Republican conference and members up there do not support additional tax cuts for the business community. They view the 2017 tax bill downfall. The one piece that was really unpopular is that the corporate rate cuts were permanent, and all the individuals in the United States are now subject to a tax increase at the end of this year because of the 2017 bill. So there's not a lot of appetite for tax cuts at the corporate level.
So Henrietta, what kind of extras can we get? Do we get no tax on tips, no tax on Social Security? What could Trump put on this to make it more than just an extension of TCJA?
That's a great question. The no taxes on Social Security is physically not possible. They're not permitted to address Social Security in any capacity using reconciliation instructions. So that's entirely off the table. And just so we're clear, the cost of doing that would be $1.8 trillion. So if it was not physically impossible, it's definitely monetarily impossible. The no taxes on tips piece doesn't have a tremendous amount of support because there's not been enough education or discussion of how to rein that in so that you don't avoid, a CEO saying the $1 million that I made last year is actually just a tip and evading taxes. So they don't have the logistics worked out for that. And then in addition, that's not a universal tax cut for all individuals. It's only a tax cut if you get tips, which not everybody does. So it's disproportionately impactful to different states. That was a big sell in Nevada, but Nevada does not have Republican senators. So it's going to be really difficult to get that over the finish line. There's not a lot in there that can be described even charitably as stimulative.
So once again, the conclusion of the U.S. economist and investing community on tax cuts. It's not actually going to happen, but if it did happen, massive harm might be done. That brings us to deregulation. So reduce regulation on businesses so that businesses can grow and flourish. It sounds really, really nice. And actually, there has been some deregulation, but mostly only in crypto. You got to hand it to them. They have done deregulation in the crypto sector. That being said, we have a pretty similar FTC regulatory landscape as we did before for non-crypto big tech. That's not helping. And we have the continuation of ideological regulation. So the previous administration was ideologically opposed to crypto, and they increased regulation because of that. This administration is ideologically opposed to DEI and immigration, so they are increasing regulation related to that. The big story from today was that the FCC is investigating Disney and ABC for DEI initiatives. Federal government is being weaponized against businesses and increasing regulation for ideological purposes. So they're also talking about closing tax loopholes like cruise ship flagging and offshore tax havens. That's new regulation that will be bad for corporate profits. So the conclusion of the US economist and investing community on deregulation doesn't seem to be happening, but even if it does, it might not matter. Now, when it comes to immigration, economists are concerned about that also. They're concerned about tightening labor conditions. One thing that's been a bit overlooked, though, there's this Trump card, which is essentially a visa that people can buy. People who have enough money can purchase to come and move to America and receive some kind of permanent residence here in America. And some in the administration are saying that it might lead to 1 million people coming, and Trump himself is hoping that 7 million people will come. But no one seems to be talking about the fact that that could potentially be inflationary. Obviously, they're excited about the possibility for it to pay down the deficit. But imagine if we were saying that all these millions of unauthorized immigrants coming to the US caused a frozen housing market or contributed to it and contributed also to inflation. Imagine 7 million higher earning people coming to the US. Don't you think that might actually cause some inflation or increased problems in the housing market? No one even mentioned that. The conclusion of the US investing and economist community on the overall economic policy is that it's just not well researched or thought out and probably harmful. And that's why your stocks are down today. Now, the silver lining for all this is that, well, there are two things. The Trump administration is already starting to back off of their tariff talks. So they're saying the April 2nd tariffs won't be horrible, won't be as bad, meaning they're starting to get the message that the market is sending. The market may see April as a clearing event, and if additional tariffs aren't as bad as expected, the market might get a short-term pop, might. And a lot of equity analysts are looking at oversold conditions and calling for a short-term pop. That being said, a short-term pop might be an opportunity to reduce losses, sealing gains, or even put on bearish trades like buying put options or selling call options if you want to go that far. What I personally have done, I sold my crypto a while back when Bitcoin was around 93,000, and I reduced my AI stock positions days ago when the market hit a local high. I mean, my goal is not to give anyone the impression that they should be buying tech stocks right now. So for anyone who does want to continue to add to positions on pullbacks, I think it's important to know which companies will be the most or least affected by either a recession or tariffs. So what we did is we went and asked deep research. We used OpenAI deep research along with Grok deep research, and we asked them pretty much that. Which stocks in our gigantic AI portfolio will be most or least affected by tariffs and also by a recession? So really interesting answers that we got on this. Firstly, to tariffs. There was unanimous agreement that Amazon is going to be the most detrimentally affected company by tariffs. So both models agreed Amazon's heavy reliance on imports from China exposes it to significant cost increases from tariffs. But it wasn't just Amazon. Some other honorable mentions of devastatingly affected by tariffs are Taiwan Semi, Applied Materials, Vertiv, GE Vernova. You might be saying, why Vertiv? Why GE Vernova? Well, it's mostly due to the steel and aluminum tariffs. Also, Eaton, Trane, Johnson Controls. Trane and Johnson Controls are cooling stocks. Broadcom, Qualcomm, Talon Energy, some kind of Canada tariff connection there. And then lastly, Micron. Now, the least likely to be affected by tariffs, Synopsys, software company, Cadence Design Systems, software company, Palantir, software company, Tempus AI, medical software company, but also a small cap, so watch out. And then Uranium ETFs and SAP, also software company. So mostly the software companies are expected to be fine from tariffs. What about a recession? So I went ahead and I told Deep Research the definition of recession, and I did actually require it to consider 2 consecutive quarters of negative GDP growth, which isn't always part of recession, but I thought I'd throw that in there because we're already down so far. I don't want it to think that we're already in a recession. So both models actually said the most likely to be negatively affected by a recession stock is Meta, of course, due to its heavy reliance on advertising. So it was rated a 10 on devastatingly affected by Grok and an 8 by OpenAI. Honorable mentions for also very badly to be affected by recession: Taiwan Semi, Applied Materials, Lam Research, KLA, Onto, Qualcomm, Train, Johnson Controls, and Micron. You might have actually noticed a few stocks that were on both of the list of terribly affected by tariffs and recession. And yeah, that's Taiwan Semi, Applied Materials, Qualcomm, Train, Johnson Controls, and Micron were on the list for both of those. So what I will be doing if we get a pop, I'll probably be reducing exposure to those specific stocks because I know those stocks are most likely to actually see a change in their revenue and their earnings per share once these things get going. And I don't necessarily think we'll have both recession and devastating tariffs, but it's looking like the devastating tariffs is pretty likely. So least likely to be affected by a recession, we've got Tempest AI, Constellation Energy, and Axon. So Axon is mostly public safety with stable government budgets. Constellation Energy, nuclear energy, and then Intuitive Surgical is, of course, medical. So yeah, we had actually uranium show up on the most likely to be affected list for both of those. 2 closing thoughts on AI. xAI just bought X. So an AI company that was stood up in a matter of months just bought a social media company that has been around for decades. 400 million people are using ChatGPT every week. That means over 5% of the world population is using AI now every single week. And a recent MIT study just found that some heavy users of ChatGPT are actually starting to become emotionally dependent on it, aka addicted. And as Nir Eyal once said, the most successful businesses are those that sell addictive products. AI isn't going anywhere. No company can afford to miss out on the next big technological revolution, and China and the US are in a war to become the leader on AI. There's still a lot of money to be made in AI, but for now, be careful. So next week, there's a lot of economic data coming out in addition to Liberation Day. And next week could be a temporary recovery, or it could be the beginning of a real bear market. No one knows, not even Deep Research. All I know is that things have gotten significantly worse since our last episode. The show that has been 2025 is guaranteed to continue. And the only thing that is yet to be seen is if this show becomes a cluster.
The first revolution is when you change your mind about how you look at things and see that there might be another way to look at it that you have not been shown. You will not be able to stay home. You will not be able to plug in, turn on, and pop out. The revolution will not be televised, and be no rerun, brothers and sisters. The revolution will be live.